Good morning, everybody. September 15, 2020 School Land Board meeting will now come to order. Pursuant to the Governor's executive order to avoid gatherings of more than 10 and the Governor's March 16, 2020 suspension of certain provisions of the Open Meeting Act, the September 15, 2020 meeting of the School Land Board is being held today by video conference call as authorized under the Texas Government Code, Section 551, Tech 125. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Open Meeting Act. Any member of the public who wishes to address the board on a matter within the authority of this board should indicate so at the start of the meeting or during any public comment period. The chairman may limit the time available to each individual. I believe we have a few visitors that will speak on the praxis item. We have a visitor on the RVK item and also in connection with item number 7. We'll ask those visitors to identify themselves as the agenda item comes up. So first item on the agenda is approval of the minutes from our last meeting, August 18, 2020. I've had a chance to review the minutes, and assuming the board has done so as well and there are no questions, I could entertain a motion to approve the minutes.
Motion to approve.
Second.
Motion is made and seconded with one abstention to approve the minutes. Next item on the agenda is the approval of the consent agenda as posted. Assuming no questions, comments, I could entertain a motion to approve.
Commissioner, that was me. That's Michael. I move we approve the consent agenda.
Second.
Motion is made, seconded, and carries to approve the consent agenda. Next item on the agenda is presentation by RVK. The legislature required a study on the distributions from the PSF to the ASF, and we look forward to this item.
Mr. Chairman, this is Rusty. Mr. Chairman, members, for the record, my name is Rusty Martin, Chief Investment Officer of the General Land Office. Just to reiterate, this is a non-voting item. As you will recall, HB 4388, which was passed in the 86th legislature in 2019, required several things. First, it required the creation of the permanent school fund liquid account. Secondly, it required the exchange of quarterly investment reports between the School Land Board and the State Board of Education. And third, it required the completion of a study by Texas Education Agency in consultation with the General Land Office that examines the history and the processes related to distributions from the permanent school fund to the available school fund. And the goal of that study was to develop options to maximize distributions from the PSF to the available school fund while still preserving the PSF for future generations, i.e. intergenerational equity. This study was done over the past few months by a company called RVK Inc. The RVK representative, Ryan Sullivan, has agreed to present the study to the board and answer any questions that you have. So with that, I'll turn it over to Ryan and remind you once again that this is a non-voting item. Thank you, Mr. Chairman. Ryan?
Thank you. I am Ryan Sullivan from RVK. I led the completion of this project at RVK, and Mr. Martin has asked us to briefly go through the key findings with the board today. Please let me know if you have any questions. I'll target about a 10-minute presentation based on feedback from Mr. Martin. Is it okay if I share my screen with a few slides?
That'd be great.
Okay. Apologize. I don't know. There we go. So, as was mentioned, this study was required by Texas House Bill 4388 and required for this portion of the study to examine several key aspects of the permanent school fund both from the State Board of Education's perspective, their portfolio, as well as the School Land Board's investment portfolio. It's no surprise to anyone on this board, but the PSF is a unique entity. It is considerably complex when you get down to looking at how it operates. There are multiple investment portfolios managed by multiple boards and subcommittees, different pieces of which interact with each other in different ways. And so the first objective that we tried to accomplish in this study was just outlining what are the different pieces of the permanent school fund, who manages the assets, where do those assets go, can they be distributed, et cetera. And so that's what we've highlighted on page 3. I'm not going to go into great depth here other than to note that this really is something that is unique in the U.S. Part of the project was to look at other institutions in the U.S. that have similar objectives in terms of funding public school education in the country. There are several other organizations, but none of which operate in the manner that the PSF operates in. So that's kind of the first key takeaway, really, is that this is a unique animal, and you've really got to understand several different pieces to try to understand how assets flow and how distribution decisions are made and how that ultimately ends up supporting public education in the state of Texas. When we look at the actual study and the findings from the perspective of the SLB, we find that going forward, a sustainable distribution rate is between about 5.3% and 5.7% of the RESFA assets. And that's an important distinction. When we looked at the distribution rates, we looked at them individually for each portfolio. And so this rate, as we calculated it, is for the RESFA assets, which excludes the liquid account assets. When we look at the SOB's portfolio, we find their sustainable distribution rate is about 3.2% going forward. And when you combine these two pools of assets for a PSF total distribution rate of about 3.26 to 3.46 going forward, are the rates that achieve intergenerational equity based on today's capital market forecasts, student population growth rates, investment approaches in place, and just general conditions. These rates will certainly fluctuate through time based on all of these factors, and periodic reassessment is critical in making sure that distributions don't become too low or too high and start favoring either the current generation or future generations per the Texas Constitution to maintain that level of intergenerational equity going forward. A quick note on the bond guarantee program. We recognize this is a critical component of the overall public or permanent school fund. It was outside the scope of our project to review this in its entirety. We did think that it was important enough, though, just to note that we spoke with the rating agencies to gain an understanding of the program, and the rates that we have found and any recommendations in the full report itself, we believe maintain the strong AAA rating of the program going forward, and think that there's very minimal probability that will be decreased in the future given the strength of the underlying program. On slide 6, we talk about what is intergenerational equity in order to come up with the rates that I just stated, and I'll walk through quickly how we came up with those in a minute. But what is intergenerational equity? We find there's two different viable metrics for measuring intergenerational equity going forward. The first being that each student receives the same inflation adjusted or real market value benefit from the portfolio. So said another way, as you go through time, the real market value per student remains constant. That's one definition of intergenerational equity. The second is that the distribution per student stays the same after inflation going forward. They're very similar, but there are a couple of key differences between the two definitions of intergenerational equity. Based on our review of the permanent school fund, we've found that there seems to be an attempt to balance between the two going forward. And this is probably one of the areas that we saw some of the most difference between peers across the US is just what is the definition of generational equity. And if you look in our full report, which I encourage you to read, you'll see there's some discussion on, we believe both boards, the SBOE as well as the SLB, should spend some time discussing exactly what is meant by intergenerational equity going forward and how it is defined and measured going forward. We think can keep the focus on maintaining the value of the portfolio for students going forward. I'm not going to go through the historical review of the program in any depth. On page 9 of this presentation, we do show various distribution rates over time, what they've averaged for the different portfolios, as well as looking at it, including different values in the denominator. That's one thing that we noted in the review of this program is the distribution rate itself can be calculated in many different ways and include many different combinations of assets, each meaning something different to different groups within the state of Texas. So we've looked at it in a broad array of historical measures on slide 9. You can see what those historical rates have been, largely in line with what we expect future intergenerational equity rates to be going forward. When we look at what we think can be distributed going forward, we looked at several different factors to develop a model, and then we modeled the current environment 2 different ways going forward. I'll walk through each of those in a minute, but the components of the model are expected returns based on capital market assumptions, based both on RBK's own internal capital market assumptions as well as an outside source put together by Horizon Actuarial. It's a survey of other investment consultants across the US, so it's kind of an average summary. The 2 numbers ended up being quite close, as you'll see in a minute. Inflation expectations, we reviewed several different inflation expectations going forward. Inflation is one of the hot topics right now in the capital market arena. Generally, I think the consensus is we'll have lower inflation over the short to medium term with the possibility of higher inflation over the long term. You can see here we have 5 different sources of expected inflation. They all fall between 1.5% and 2.5%. So no matter which one you go with, the impact on the rate is minimal. Student enrollment growth rates, I'm not going to go into this in great depth, but we review this in the full study and find about a 1.2% growth rate going forward makes sense based on demographic projections from the Texas Demographic Center. Corpus growth rate target, we have assumed that this should be 0 going forward based on stated goals of achieving intergenerational equity. If you are targeting corpus growth, you're pretty much in direct violation of intergenerational equity mandate from the beginning. And then we looked at expected cash inflows, and this is really for the RESFA with the income from the land and mineral assets coming in. We worked with Rusty to come up with a reasonable estimate on the conservative side for what cash inflows might look like going forward over the long term, recognizing the fact that this is an extremely difficult activity. And so we use quite a bit of conservatism in this number, as you'll see in a minute, but we think it should at least be recognized in the fact that it does support higher distributions, particularly for the RESFA going forward. When we put all of those factors together, I'm going to focus on the bottom right of this table, which is for the RESFA portfolio. We expect the expected return to be about 8% going forward based on RVK's capital market assumptions. We subtract off inflation, and we subtract off student growth rate, and then we add in asset inflow and what that does to spending rate going forward. And we come up with a sustainable distribution rate of about 5.3% using this methodology. So this is where the first number on the first slide came from, is this very basic model of what is sustainable going forward based on each of these components. We then looked at a second model that takes investment returns and makes them now, instead of just that 8% per year based on a single estimate, we used a Monte Carlo model and modeled asset flows as well as assets going forward, distributions and student population growth rates and inflation, made them all stochastic or all random based on historical distributions of how they've behaved, and repeated that same model, but based on 10,000 different trials of future economic activity, and found that the distribution rate that supports achieving intergenerational equity in this model is about 5.7%. So you can see the two different models produce similar results, right in the mid fives going forward from the RESFA assets. On the bottom of this table, we then put a little bit of a sensitivity analysis. So if 5.7 is the rate that produces a 50-50 probability of achieving intergenerational equity, what happens if you decrease it or increase that distribution rate by 25 basis points? You can see the impact on the probability of achieving intergenerational equity going forward. So for example, a 6% distribution rate would equate to a 47% probability of achieving intergenerational equity going forward. And then finally, the last section of the report is on the peer review. We reviewed the funds listed on this slide. There's about 10 of them, and summarized the results in the study itself. I won't walk through those today in the interest of time, other than to note again, probably the biggest difference we found between both the SBOE and the SLB and many of these other peers is the stated intergenerational equity metric that is being targeted over time, and kind of a consistent monitoring of that metric in terms of every couple of years looking to see if that objective is being met. So I think that's a discussion that would be beneficial to the board, is defining exactly what is meant by intergenerational equity, defining a metric and reviewing it from time to time to make sure that the overall objective is being met. And with that, I'm happy to answer any questions. I know I walked through that fairly quickly, but happy to spend as much time answering questions as needed.
Any questions from the board at this time?
Yeah, this is Todd, if you can hear me. On this slide that we have right in front of us, so your conclusion is that the funds that we're talking about here, SLB and SBOE versus these other funds, is that there is generally more transparency with which set of funds, the peers or ours?
The peers. And let me clarify that to some degree. That is more so on the SBOE side, where their distribution percentage is, from our review, is more of an ad hoc basis where there's not really a formula in place. There's a formula in place for how it can be calculated, but in terms of actually coming up with the next biennium's rate, there's no formula forcing them to commit to a certain percentage.
Okay. And maybe this is a question for you or for Rusty. You know, we talked about the range of inflation rates estimates, and I think you basically said they were between 1.5% and 2.5%, depending on who you talk it to. If I'm just trying to understand, 1% of inflation rate on a $50 billion collective portfolio is probably about, if you believe that inflation was 1.5 versus 2.5, that's about a $500 million extra distribution per year that could be made if you were more bearish or bullish, depending on your perspective on what inflation was going to be. Is that fair?
Yes, that is fair.
Okay.
This is Scott Rorman. I joined a little late. Sorry about that. I had a emergency I didn't expect. If you've gone over this, or if I should already know this, and I apologize for my dense nature here. But the question I have is, for the school land board, how much are we supposed to give out of our coffer to school children of Texas every year? And is that a percentage? I think it's my understanding that there's no statute, but that we've used a rule of thumb. Is that right?
Rusty, do you want to take a crack at that?
Sure, Mr. Commissioner. So Scott, we do not have a mandate for distribution to the available school fund, but the board has adopted a set of rules in the Texas Administration Code that dictates their approach, your approach to determining how much, if any, to release from the RESFA to the available school fund. And at this time, and since the beginning of those rules, that has always targeted 6% of the trailing 16-quarter average market value of the portfolio, plus cash, which, as you know now, the cash is kept in the liquid account instead of the state treasury and managed by SBOE.
Quick, 6%
We
of the trailing.
still calculated that just started in September of last year. For the release that you just approved at your last meeting, we still included the liquid account in the calculation to determine the amount to release. What Ryan has said in this report, and I don't know if you noted it, he went over it a couple of times, but when he's talking about the 5.7%, he is only referring to 5.7% of the trailing average market value of the investment assets themselves. He is not including cash. So when you put that in the mix, the board is actually releasing at this time quite a bit more than he's recommending be released. Now, I think he would say, and I'll let him speak to that, that over time, as the liquid account becomes fully invested, that evens out, and we do approach that sort of 6% release value.
Okay, so is it true to say that the school land board, as a board, has adopted rules, and those rules we could change at a vote of the board? Is that right?
Yes, there's a process, but the board could take action to institute a change, and we would have to go through the process to get public comment. But yes, that is correct.
Okay. And then what is the mandate for the SBOE?
It's 0 to 6% of the trailing 16-quarter average market value. And then they have a further restriction that has to do with their performance over a 10-year period.
Okay. What is that restriction? Am I asking you something you really aren't required to know?
I don't know verbatim what it says, but it basically implies that if the value of the fund falls below the 10-year average value, that they don't make a distribution for that period, something along those lines. So there is a restriction.
It's the investment.
It has kicked in the past, at least once that I'm aware of.
Is it true that they can do 0 to 6% at their choice? In other words, one year they could say, if they're above that 10-year, valuation, they could say, we're going to give 1% this year, and they can give 6% the next year.
They have the flexibility to make determinations the same way that the school land board does, somewhere between 0 to 6%.
And do they have rules that if they were to change those rules, they would have to go to public comment before they could vote to change them?
I defer to legal counsel on that. My assumption would be yes.
They have a constitution that they're bound, that restricts them. We have rules which set up how we determine upon which Rusty then makes a calculation as to our 6%. It's constitutional as to the maximum they can distribute.
For the record, that was Jeff Gordon, General Counsel.
Thank you.
And boy, I love it when the commissioner corrects Jeff on procedural matters. It's kind of fun because Jeff's so good at them. So the question I have is it clear what the numerator and the denominator are for us? And is it clear what the numerator and denominator is for the SBOE? Or is there lack of clarity?
In what context are you speaking, Scott? The rules that you adopted are clear, yes.
When the legislature is told by us, and when the legislature is told by the SBOE that we just gave X% of our portfolio to the available school fund, are those numbers and how they calculate those and how we calculate those, are those transparent and clear?
Are you talking about what is said in this report as compared to what we actually release?
Well, yeah. I mean, to me, it's just simple math, and I'm sure it's not as simple as I want to make it. But
well, no, it is simple math, but the difference here is, and I don't want to speak for Ryan. Let Ryan speak, but basically, his study is when he says we should be releasing between 5.3 and 5.8%. He's only talking about the investment assets. He is not including the money in the liquid account. Ryan, isn't that correct?
That is correct.
yeah, and Rusty, I wrote that down earlier, and I really appreciate that clarification. What I'm asking is it pretty clear for both us and SBOE? And I know that I'm not sure that Ryan has any window into the SBOE, but is it pretty clear how to calculate the numbers? Because in the past, I've gotten confused. When I've gone in and tried to say, well, how much are we given versus how much is the SBOE given? And at one point, I could have been wrong, but it looked like they represented to the legislature that they gave X%, but it looked to me like they got to that percentage by counting the money that we gave. And that seemed disingenuous to me, but I may have just been off base.
Well, no, I think you're correct in that leaving the adjectives aside, I think you're correct in that in the past, when the board has released money to the state board instead of the available school fund, that the state board has then taken that amount and added it to the amount that they had voted to approve to release. That is
Okay.
correct.
Okay, okay. So, all right, this has been very helpful for me. I hope I didn't monopolize the conversation too much.
Scott, let me give you a perspective for whatever sort. The way I think about it, there's roughly 36 billion in the SBOE portfolio. There's roughly 12 billion in our portfolio, of which roughly 4 billion, I think, and I'm going to be off a little bit, Rusty, please correct me. Roughly 4 billion is in cash, 4 billion is actually invested, and roughly 3 to 4 billion is in the minerals. And so when I think about all this, the SBOE portfolio is a fully balanced portfolio, fixed income, public equity, private equity, et cetera. It is a full portfolio. Our portfolio is the higher risk, higher return assets of a balanced portfolio. It's the private equity portfolio. We should generate a higher return overall than SBOE should generate on their portfolio because, again, we're talking about one slice of the capital structure. And so I think the thing for us collectively, and I think this report is helpful, is what really matters is how much is total assets per kid, inflation adjusted, changing over time. Because that's the number we want to make sure doesn't go out of whack, either high to the high or to the low. And I think inflation adjustment is a big deal because 500 million is a lot of money, depending on what you want to assume on inflation. And the SBOE, I think, has historically been assuming higher student growth recently than what's been actually occurring. And so I think they're now adjusting that distribution, that assumption, which is meaning they're able to distribute more because they're assuming less student growth, which means you can have, you don't have the assumption of having to retain more funding to make sure you, for a higher student growth number. So I think the key thing for me that I think about in evaluating all this is what's the total distribution coming out of both portfolios as a percentage of the amount under investment, and is it staying inflation adjusted per kid?
And Todd, if I could just interject there.
Sure.
Because you asked a question about the last slide that Ryan went over in his meaning when he used the word differential in transparency.
Yep.
What he was talking about was exactly what you just mentioned. You stated clearly that in your mind, the intergenerational equity is based on not distribution that's based on inflation adjusted asset valued over time. And what Ryan was saying is that SBOE has been trying to balance the two instead of picking one. And Ryan, again, if I'm misstating what you intended, please step in. But I think what you were intending to say was that the two boards should probably try to get together and come up with a unified version of what is that fundamental goal. Is that right, Ryan?
Exactly. That's exactly what we're trying to say.
And with the legislative
Go
change, for what it's worth, but that basically disregards the issue of the instructional material issue, which was before a point of contention between the two boards in terms of how each dollar was treated that was being released to ASF. Now we can do exactly that. With this information, we can leverage our joint SBOE meeting with our board and try to peg to a figure so that the release is pegged to what it means per student, inflation adjusted. And that helps to get rid of the politics and gets rid of the obfuscation around what is being released to ASF and why.
Yeah, Commissioner, the legislature made that decision for us, right?
In terms of the instructional material issue, yes. I mean, it was in addition to the liquid account modification and the other bills that dealt with the the PSF.
Yeah, so
But
in the
to me, it was a
past-
big difference in terms of getting us to our point.
Yeah, my understanding is in the past, if we gave the money to the SBOE by statute or law or ordinance or something was required to spend 50% of all their money, or the available school fund was required to spend 50% from the SBOE on instructional material. If when we gave money directly to the available school fund, that requirement was not there for those funds. The legislature then changed it to say, it doesn't matter if we give it through the SBOE or directly to the available school fund. Now all that money has to be spent 50% on instructional materials. Is that a correct summation?
That
This
is.
Jeff.
Thank you for the
Yes.
leading question.
Yes, this is Jeff. That's correct, Scott. The legislature changed, I think it's chapter 43 of the Education Code, which now includes, in terms of that split, distributions from the provision in the Constitution that the board makes distributions from. So yes, that has been changed.
Okay, so, my personal feelings don't have to come into play there. I just have to obey the law as it concerns this money. So I agree with you, Commissioner. That question is not in play for us anymore.
Can I ask one other question of Brian? One of the fundamental questions you asked that we should try and get aligned per your suggestion with the SBOE board is the goal to have a real value per student over time or a real distribution per student over time? And which one is going to, I think I know the answer, but just which of those methodologies is going to create more volatility in annual distributions?
Well, the real market value per student will create more volatility in the distributions over time.
Yep.
Both are accepted definitions of intergenerational equity in the US, and neither one is right or wrong, but you cannot optimize to both.
Mm-hmm.
You have to pick one. You can try to manage around both of them, but at the end of the day, you can only really achieve one over the long term. And now you might be able to achieve both somewhat close, but in managing one, the other one is going to have to give at some point.
And which approach is SBOE using today? Value or distribution?
That's where we advise to them to pick one more clearly. They state that they try to do both, which we think is suboptimal. We think picking one is the optimal approach. And from our perspective, it doesn't matter which one. We can't say which is best for the state of Texas, but we can recommend picking one and focusing on it and being constant in that year over year. They're trying to do both because there's merits in both, but I think at the end of the day, the students of Texas would benefit from a singular focus by both boards.
Thank you.
Any other questions from the board? Just in closing on this agenda item, I would just personally ask if Rusty could work with you, Ryan, on the peer review data, just to see kind of where we stack up against some of our fellow colleagues and other state managed trustees, and to the extent you have any data on private universities, that would really be helpful too, because that's something we were taking a look at anyway in terms of a joint board and researching further. So really appreciate your presentation, and assuming no questions, we could wrap up agenda item number 3 and jump into number 4, which is an update on Hurricane Laura.
Thank you.
Thank you, Ryan.
Good morning. Amy
Morning.
Nunez, Coastal Field Operations. Item number 4 is an update and possible action related to the approval of a timeline for the repair and rebuild of structures that have been damaged by Hurricane Laura. As you recall, last month we brought before you 2 items from damages to structures from Hurricane Hannah. Since that time, another storm impacted the Gulf Coast. On August 27th, Hurricane Laura made landfall near Cameron, Louisiana, which is about 30 miles east of the Texas border. It was a Category 4 storm with maximum sustained winds of about 137 miles an hour. There was damage to structures in Texas as a result of this storm. We did do an inspection on some of the cabins in Brazoria County, and they did not have any impacts as a result of this storm. So we don't have that item as we had last month, but we did identify, staff identified approximately 60 piers that were damaged in excess of 60%. Another 40 piers did have damage as well that staff identified less than 50%. These structures are authorized under Chapter 33 of the Texas Natural Resources Code. Most of these are authorized with a coastal easement or structure registration. They're mainly residential pier structures. And just similar with Hurricane Hannah, pier repair has begun in accordance with their respective contracts. As always, any commercial structures that were damaged by the storm must also rebuild in accordance with their contracts, and any modifications to the footprints will require approval from the school land board. Consistent with Hurricane Hannah, for Hurricane Laura, staff is again recommending all repairs be completed on a 1-year timeline. So that would be August 27th, 2021. Staff also requests the ability to authorize additional time to perform these repairs to be granted on a case-by-case basis as circumstances warrant. We do recognize that funds and contractors availability and of course, other potential storms are some of the factors that can affect the timelines of these individual repairs. I'll be happy to try to answer any questions.
Any questions from the board at this time? Assuming no questions, could entertain a motion to confirm staff recommendation.
So moved.
Second.
Motion is made, seconded, and carries unanimously to approve item number 4. Thank you very much, Amy.
Thank you.
Next item on the agenda is number 5. I'm going to ask for Mr. Pickett Prather to present after staff presents. We'll have staff lay out the issue first.
Good morning. This is Ken Mills with the Oil and Gas Section in the Office of General Counsel. Item 5 is an application by Praxis Oil and Gas to waive its agency rights and take a lease directly from the school land board. As you know, under the Relinquishment Act, surface owners act as the state's agent and have the executive right to sign oil and gas leases. And there is a rule against self-dealing in that act. But under section 52.190 of the Natural Resources Code, a surface owner can apply to the school land board to waive its agency rights and take a lease directly from the board. That's what Praxis is doing here. It owns a net 26.667 acre interest out of 160 acres. And they are asking to lease that net acreage with a $250 an acre bonus, which comes to just under $6,700, and a 25.5% royalty. And since they're waiving agency rights, instead of the board getting half as it ordinarily would, the board would get the entirety of that royalty on a 2-year primary term. With their application, Praxis submitted all the information the statute requires regarding its experience and some other things. And staff is recommending that the board accept this waiver of surface rights and approve the direct lease to Praxis on the terms that I just laid out. And I'd be happy to answer any questions.
Any questions before Mr. Prather presents? Hearing none at this time, Mr. Prather, the floor is yours.
Yes, let me say thank you for having me. Commissioner Bush and the other board members, thank you very much. I've been very grateful that the staff has helped me through the application process, just with details and figuring out how to do this. And I appreciate their recommendation. Thank you all. It is true that the state, I am the larger landowner for that tract of land, and I would be, for the duration of the lease, ceding my royalty to the state. So that would be good for the public school fund. Another point which I think the board would be interested in is that I am offering the very high bonus rate, certainly higher than anyone else offered, to lease the land. I also am offering a higher royalty rate than anyone else. And I'm able to do that because I've had geological studies done, which, as you can understand, those would be proprietary, and I wouldn't want to release the specifics in the public forum, but I'm able to offer these higher rates because I believe the geology looks very promising. And there are some things which may have been missed by former operators. So that's all I will say, except that I'm certainly available for questions, and I'll turn it over to you, gentlemen.
Thank you, Mr. Prather. Yeah, thank you for joining us. A little bit easier to do it via Zoom than traveling to Austin nowadays. Any questions from the board of Mr. Prather or of staff? Hearing none, I could entertain a motion to confirm staff recommendation at this time on number 5.
So motion.
Second.
Motion is made, seconded, and carries unanimously to approve item number 5. Thank you, Mr. Prather, for joining us this morning. Items number 6 through 9 will be held in executive session. We'll enter into it pursuant to Chapter 551, Subchapter D, Section 551, Techo 71 of the Government Code for discussion consideration regarding pending or contemplated litigation and or settlement offers. Items 6 through 9 on the docket will also involve discussion and consideration concerning purchase, sale, exchange, lease, or value of real property. Following executive session, we'll reconvene in open session to complete the docket. The open session of the September 15, 2020 SLB meeting will resume with item number 6.
Commissioner, board members, this is Ken Mills with the Oil and Gas Section in the Office of General Counsel. Item 6 is a recommendation from staff regarding a carbon storage project. It's a two-part recommendation. First, that the board approve the tracts recommended by the Bureau of Economic Geology as being state-owned submerged lands that are suitable for a carbon storage project. And the second part of the recommendation is to authorize the commissioner and GLO staff to prepare and issue a request for proposals for a lease of submerged PSF land for infrastructure necessary for the transportation and storage of carbon, with that RFP containing at least the criteria that are set out in your board packet and discussed in executive session, and that board staff would bring the results and recommendation from that RFP back to the board for final approval. I'd be happy to answer any questions.
Any questions from the board at this time? Could entertain a motion to confirm staff recommendation.
Todd Williams, so moved.
Second.
Motion is made, seconded, and carries unanimously to approve item number 6. Thank you, Ken.
Thank you.
Next item on the agenda is number 7. And if I could, we'll have staff present first, and then we'll have Mr. Rutherford from Southstar present before the board entertains a motion to approve either items 7 or 8.
Okay. David Wells with Asset Management, and staff recommends approval of docket item number 7 per the terms discussed in executive session. Thad, you're up.
Oh, sorry. Good morning. Thank you, Commissioner and the board. I'll be brief. Just want to introduce myself, Thad Rutherford, President of South Star Communities. We are a master plan community developer based out of Florida and Austin, Texas. We've been in business for about 20 years. Very excited to work on this transaction. First and foremost, certainly want to thank Brian Carter and Russell May and the entire staff that have helped us through this process and certainly worked with us to make this transaction and eventual closing a reality. So very thankful for that. The rest of my team certainly are very excited and committed to this transaction. We got it under contract with the school land board end of the year last year, and then worked through the permitting with the city of New Braunfels. That has been a little bit challenged due to COVID-19 and not the ability to be able to meet in person with the cities and the local governments. But we have continued to persevere and work through that and feel very, very strongly about this transaction being a huge economic recovery story for later this year and next year and many years beyond. Very excited about this corridor and the jobs that this project will create. It's a future for our company, and very thankful for everybody that's worked on it. So happy to answer any questions.
Any questions of Thad from the board at this time or of staff? Could entertain a motion to confirm staff recommendation.
This is Michael. So moved.
Second, Todd.
Motion is made, seconded, and carried unanimously to approve item number 7. Thank you, Thad, for presenting. Next item on the agenda is number 8.
David Wells with Asset Management. Staff recommends approval of docket item number 8 for the terms discussed in executive session.
Any questions at this time? Is there a motion?
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 8. Thank you, David. Next item on the agenda is discussion of possible alternative investment strategies and other matters related to the COVID-19 correction of oil and gas prices. Is Mr. Martin going to lead this discussion?
Yes, I am. Thank you, Mr. Chairman.
All right.
For the record, my name is Rusty Martin, Chief Investment Officer of the GLO. And just to reiterate, this is a non-voting item for discussion only. And the genesis for this item really grew out of an informal discussion about whether or not royalty companies should be hedging their oil royalty revenue stream. The nearest comparison to our royalty structure is probably the Permanent University Fund. And although I believe there have recently been some discussions among members of that group about hedging their oil exposure. To my knowledge, they don't currently hedge their oil exposure. So we talked instead to one of our largest energy investment managers, which in addition to their upstream E&P companies also has a small handful of pure royalty interest portfolio companies. And so we talked to them about their hedging programs. So the royalty companies in their portfolios, they hedge about 35% of their PDP only revenue stream. And they do that strictly through financial transactions, mostly in the swap markets with various counterparties. Occasionally, they may also employ costless collars through options markets by buying an at-the-money put and selling an out-of-the-money call. But for the most part, they're using swap markets. However, what we found is that they're more focused on providing certainty around the cash flow they need to fund their G&A expenses, administration expenses, and to fund further acreage acquisitions during the period, as well as any covenant requirements that may be imposed by their lenders. They're focused on those things rather than protecting against pure downside commodity price exposure.
Rusty, you're on mute. You somehow switched to mute.
I'm sorry about that.
It's okay.
So what we found is that the companies are more concerned about protecting a certain amount of cash flow that they need to cover their G&A expenses, as well as furthering their acreage acquisition programs and meeting any debt covenant requirements that their lenders might have imposed on them. They're focused on those things rather than protecting against any pure downside commodity price exposure. And in fact, as they told us, they realize that their investors want potential upside exposure related to rising oil prices. If they didn't have the need for certainty with respect to a portion of their cash flow for those operational needs, they would not hedge their exposure. So what we learned from them from a business perspective was that in the absence of a compelling business reason or a set of business reasons to do otherwise, they would not hedge, but instead would welcome the potential upside weighed against the potential downside for commodity price risk. Also, we found there were a couple of legal issues that we would need to resolve before we could enter into swap transactions with counterparties or other derivative positions, but particularly with regard to swap transactions. First, there is no specific legal authority for the School Land Board or the General Land Office to enter into derivative transactions. Council is of the opinion that there may be a broad authorization in current statutes, but there is no specific authority. Secondly, there appears to be no authority for the School Land Board to pledge assets in the RESFA for the purpose of making payments to any potential counterparties. Therefore, any potential counterparties would need to find a way to get comfortable with those two issues before we could move forward if we were looking at doing something like that. At this point, I'm going to stop and open the discussion up to the board. But as you know, I want to point out Gil is a principal at one of the leading commodities hedging firms in the country. And he has a lot of experience in this area, and I'm sure he has some very valuable insights into the process that I'm sure would be happy to share with the board. So again, this is a non-voting item for discussion only. I'm going to kick it over to the commissioner now to lead that discussion, and I'm happy to answer any questions you may have.
Thank you for laying that out, Rusty, for covering not only the legal, but the mechanical restrictions and allowances that the board has. Rusty's absolutely right. COVID-19 has forced a revision of how we can actually thrive in an environment like this. And one idea that's been kicked around informally is the idea of either hedging against the risk. The only thing I could really add is that, as Rusty said, UTIMCO's basically the only parallel entity out there that has mechanisms in place. And basically University Lands, I call them our sister partner mineral manager that benefits public education, post-secondary education in Texas, is the body that handles that. And so the SBOE has more flexibility, and perhaps they're the group that should do this on our behalf, looking at the portfolio wide, and accounting for that risk, and then trying to get upside off of any substantial correction. But wanted to kick it over to Gil because he's the expert on this, and we can take the discussion from there.
Okay, Commissioner, not being prepared for this, but I'll just give you my insight. For all the years that I've been on the trading side, both on the physical and the financial side, I've never quite have understood, given the profile of the state and the lands that they own and the royalties and the values, why they've never actually hedged. Because I know a lot of people say that hedging is risky, but when you leave the pricing to the market, it's still risky. I mean, you're letting the market dictate the pricing, and oil got to $100, and we know through cycles very quickly they can drop down to $40, and you saw when we were at $60, and it just the material value. I mean, just look at the independents. It's going to wipe them all out in this last downturn. For some reason in the oil and gas industry, hedging they view it risky. Yet if you get in the refining side, you get to the big refiners, you get to the big airline industries. I mean, they all hedge. When they know that they can lock into their margin, to their profit, they hedge almost 80%. And it's just, to me, you take risk off the table when you do hedge. I mean, that's the whole purpose of hedging is not to gamble about, trying to call the market, but if anything, no one knows where the market's going. And so you're going to sit there and look at what you're trying to de-risk your portfolio. And so I mean, and it wouldn't have to be through our company or whatever. I just think it's wise in any commodity. I don't care if you're selling wheat, pig bellies, or whatever. And like most of these farmers, they do hedge their wheat because they do. And Rusty's right. I mean, a lot of these people, they're forced to hedge, and that's why you only see on the oil and gas side, on the independent side, that only 32% of the independents were hedged moving into this last down cycle. Well, look what happened. I mean, they're all going out. They're defunct. They just can't meet their obligations. And so, I think that hedging, you do hedging to de-risk the portfolio, not to add risk.
This is Todd. I'll just add to what Gil said, and because I was the one that raised this question at the last meeting. I fully understand that in a diversified portfolio that you want real estate risk, you want energy risk, you want other infrastructure risk, et cetera. And so it's expected that when energy might be up, that something else might be down, and that's how you produce a blended overall portfolio return. The one thing that I can't get my arms around is just understanding that if the single beneficiary, which is the K through 12 system of Texas, which has collectively, 48 plus or minus billion of assets under management between us and SBOE, whether or not we have a disproportionate energy risk. In other words, if we were just another fund out there benefiting public education, would we overall, just by the nature of what was contributed and what was owned and what's in the portfolios by statute, would we have the amount of energy risk that we do? And so to the extent that perhaps our overall portfolio might be 15% energy, but on a normal portfolio, if we were working with a consultant, they'd say, you might want to be 10% energy, then maybe we would hedge that extra 5%. So just something for everybody to think about. But again, it gets back to the issue of our unique fund structure, which was highlighted by Ryan earlier in this conversation. Some of the things that you'd like to do, i.e. not keep so much cash, i.e. potentially hedge, is made more difficult by the fact that we have two separate funds.
Yeah, I would agree. And I think this is perhaps a deliverable that, I can reach out to the chair of the State Board of Education on as a joint, and create a joint task force between the two boards that would dive deeper and exactly looking at that issue. Because, Todd did produce a little bit of preliminary research that shows that, roughly we're at about 50% exposure to real assets if you include the value of the mineral portfolio. We don't know where it is on the SBOE side. If we blend it all together and look holistically across the 42 billion and compare it to, say, a Yale or Harvard or whatever the peer group we decide to look at, a Colorado or an Alaska, trying to take some of that risk off the table if we are, overexposed versus our other peer groups. And, similar to UTIMCO, SBOE right now, if Rusty may want to jump in on this, I don't believe they have those restrictions. They could start an RFQ process tomorrow and start to underwrite that risk.
TIMCO already has specific derivative authority, so they could enter into those transactions. And they may already be doing transactions like that. I don't know to what extent they're employing those, but they have the authority to do that if they so choose. It'd be interesting to know what kind of conversations they're having internally about this issue and how they're thinking about it. Because if you think about the construction of the Permanent University Fund and UTEMCO, in conjunction with our structure, they are very similar. We don't have us in isolation. We do not have the same investment authority, but combined with SBOE, it's a very similar structure. So it would be interesting to know what their thoughts are about that process, because they have a lot of exposure to oil and gas, just like we do. Very, very similar.
Well, I was hoping to assign work to other people through this discussion, but it sounds like the work now is on me. But I may call members of the board to join this joint task force if Chairman Ellis is open to the idea. So any further questions of what SLB can and cannot do on this issue for the short term, and any questions for Rusty at this time?
No, thank you for the presentation.
Awesome. As Rusty had mentioned, it's a non-voting item, and there being no further business before the board, we are hereby adjourned. Thank you, everybody. Stay safe and healthy.